take it down the road. There's no right or wrong answer. It just depends on what somebody wants to do. So, and that's something that we'll be able to help you do and to figure it out and to make sure that you make the right decision. And if for some reason there's more questions after this, we can always sit down individually with whoever it is and to make sure we're on the page. So what I'm going to do is turn it over to Joe. Joe has been, again, one of my great partners, and then I'm going to give my information on here too. So I'll put it in the chat thing. So my direct phone number and my email address and all that sort. So Joe, I'm going to go and hand it off to you and put myself on mute. And when you're done, I will jump back in.
Yeah, Sharice, did you want to say a few words first before I get started?
Yeah, thank you so much, Joe. I won't take up too much time. Just want to say good afternoon to everybody. My name is Sharice Scott. I am also here at Partner Colorado Credit Union. I'm the Financial Education Manager. I will, just as Larry, put my stuff in the chat there. If you need anything additional, you can definitely reach out to me via email or give me a phone call. And ultimately just wanted to tell everyone thank you for attending today, and we appreciate you as well, Joe, for giving up your time this afternoon. So that's all.
Absolutely. No, thank you guys, and thank everyone at Partner Colorado Credit Union for having me on today. Can you guys see my screen okay? Can you see the presentation?
Yes, I can.
Okay, cool. So yeah, to Larry's comments, we're going to be talking about Social Security and really, 7 keys to enhancing benefits. So there's a lot of good information that we're going to be chatting about today. But before I even dive into that, I would just say, for those of you on the call, if you take literally one thing away from this entire presentation, let it just be this one thing, right? Social Security is not cut and dried. A lot of people think that there's one magical, one size fits all way and strategy and time to take Social Security. And that could not be further from the truth. Social Security is a very personal decision. It's a very personalized situation. And for me, this is something that we've paid into our entire working careers, right? Unless we worked in the, as a teacher, or, for the government or something, we've paid into Social Security our entire working years. And I wouldn't want to rush that decision, right? It's something that, based on if we make a right decision or a wrong decision, it could cost us tens, if not potentially, up to $100,000 or more of Social Security benefits that we did not receive. So this is a really, really big decision. It's going to be completely different for every individual as far as what makes sense on when to take it, how to take it, all those things. So if this presentation does anything for you today, I hope, if anything, it's just a catalyst to really sit down with somebody like Larry and have them really walk you through your personal situation and help you make the most informed decision possible, because it's a decision you're going to stick with for the rest of your life. So want to definitely put some thought into it and make the best choice for you and your spouse. So we'll start off with some of the basics. We'll get into income benefits, when to start benefits, working and retirement, tax implications, spousal and survivor. And we'll talk a little bit about Medicare. Before we get there, I'll just throw out the disclaimer. I do not claim to be a Medicare expert. I do know enough to be dangerous, so please don't beat me up too bad with the Medicare questions. But in all seriousness, if you have questions throughout the presentation, please feel free to chime in. Just put yourself off mute and go ahead and ask away. I encourage any and all questions, even if you think it's a bad question. I'm sure somebody has the same question that you do. So starting off with some of the basics, 65, so this is from last year, right? So June of 2020, 65 million Americans received a Social Security benefit, and the government paid out $1 trillion in benefits. Remember those numbers for the next slide. You don't have to write them down or anything, obviously, but 65 million Americans and 1 trillion in benefits. That's a heck of a lot of people, and that is a heck of a lot of money, right? So keep that in mind. But to give you an idea, the main thing I want to point out on this slide is the average monthly benefit. If you see that on the right underneath the little piggy bank, the average monthly benefit for a retired worker is about $1,500 a month. Keep that in mind, because even if you think, okay, my house is paid off, my cars are paid off, I don't really spend a lot of money, you're not going to get to keep that full 1,500. We'll talk about that. There's going to be taxes coming out of that. There's going to be Medicare premiums and things coming out of that. So just keep that in mind. That's an average benefit. The maximum benefit at full retirement age, at least, is about double that, but you could also potentially get less than that as well. So moving on, remember these two numbers, 65 million Americans and $1 trillion in benefits. Because the number one question I get when I do a Social Security presentation, people all want to know, well, that's all good information, Joe, but is it really going to be there for me, right? Is Social Security really going to be there, down the road or when I need it? And look, I might be the ultimate optimist, but I would say absolutely. And the reason I think it'll be there is, again, because of 65 million Americans and $1 trillion of benefits. That's too much money to just be extracted from the US economy. That would cripple it absolutely as we know it, pandemic or not. And 65 million Americans, that's a heck of a lot of votes, right? That could easily win an election if that was on the ballot, basically, to save Social Security. So here are the facts, though, right? That's kind of my opinion. Here are the facts. By 2034, the Social Security Trust is expected to be depleted. Now, don't panic. Think of the Social Security Trust as a bucket of money. We all know how Social Security is funded, right? Through our tax dollars. If you ever look at your bank statement, you see your pay stub. You see Social Security being pulled out of your pay stubs and your paychecks, every month. And that's how Social Security is funded. So think of the trust as basically a big bucket that money is constantly flowing into from tax revenue, and money is constantly flowing out of in terms of paying benefits out. So it's really kind of like this reserve tank, like a slush fund, basically, that money's constantly coming in and going out. So just because that's depleted, it doesn't mean that there's absolutely no money. It just means there's more money coming out than there is money coming in, right? Which is still a problem, don't get me wrong. But even then, it is projected that enough revenue should be coming in to pay about 76% of scheduled benefits. So it's not like we're going from, Social Security is fully funded, and then all of a sudden, 13 years from now, holy cow, there's not a penny left. It's just we have to fill that gap. We have to fill that, call it 25, 24% gap to full solvency. So again, do I think Social Security will be there regardless of how old you are? I would say absolutely. Do I think Social Security is going to look the exact same for younger generations? I would say absolutely not. And Social Security has changed in the past, and it's going to continue to change in the future. It simply has to. One of the biggest changes that people talk about is slowly raising the full retirement age. And if you're approaching Social Security age, don't get mad at me. They're not targeting you. They're targeting younger generations, right? People that are still 10, 20, 30 years away from taking Social Security, they might slowly start to see a slight increase in their full retirement age, and potentially even at their earliest retirement age, which is currently 62. And I think that makes sense. Why? Because, think about it. People are living longer than they ever have before, right? So if people are living longer than they ever have before, but the full retirement age stays the same, that means people are going to be paying into the system for the same amount of time, but taking benefits in theory for a much longer period of time. That math just does not work, right? So slowly, there will have to be some changes made to Social Security, and I do believe they will start with slowly upping the full retirement age for younger generations. There's a lot of other proposals out there in terms of increasing the tax amount or the maximum amount of income that you pay taxes into Social Security and other things as well. But nothing's like really on the ballot, nothing's in the House or anything like that right now. These are just kind of ideas from, economists and folks alike on ways to quote unquote save Social Security. So again, if there's any questions, feel free to send them in the chat or, unmute yourself and speak up for sure, but I'll keep moving. That tends to be a big topic. Last little bit of the basics. If you have not already, make sure you create an account online. The website is basically ssa.gov. I know that web URL is pretty daunting, but if you just Google ssa.gov, it should be the first link that pops up. Please make sure it's a .gov website. I don't want anyone to enter their Social Security number into a spam website or something. The website itself should look exactly or very similar, at least to the screen on the right there. And it's very easy. You just hit create an account. You have to know your social security number. You have to know your, email, your name, all that good stuff. And they ask you some of those almost like credit check questions, which of the following addresses have you lived at and all this kind of stuff. But there's a ton of pretty good information out there. We'll come back to this in a second, but it'll have your earnings history. It'll have your full retirement age benefit. You can print off statements, all these things. So it is very good to have a login just so you can get access to more information, and especially if you take the opportunity to sit down with Larry and have him help you optimize your Social Security strategy. He has access to one of the most comprehensive Social Security tools out there. You'll definitely need a statement just so you're using accurate information. And this is a really easy way to go ahead and print off a statement from the ssa.gov website. So make sure you check that out too. Okay, moving to the good stuff. We'll talk a little bit about income benefits. So, before we get excited about all this money we're going to hopefully get right from Social Security, we want to make sure we qualify for a benefit. And I'm sure everyone on this call does or will qualify for a benefit. But just so you know how that works, in the eyes of the government, you have to have earned what they call 40 credits. And 40 credits is really the equivalent of 10 years of work. You can earn up to 1 credit for every, in 2021 at least, you can earn up to 1 credit for every $1,470 you earn, with a maximum of 4 credits this year if you earn $5,880 or more. So you really don't have to make a ton of money to qualify for your 4 credits. And technically you only need to have had to pay into Social Security for up to 10 years to actually qualify for a benefit. But hold that thought, because the way they actually calculate your benefit is they use something called your average index monthly earnings. The acronym is AIME, A-I-M-E. And even though you only need 10 years of work history to qualify for a benefit, they actually take into consideration your 35 highest wage earning years. And it's not just your 35 years of working, it's 35 years of working where you actually paid into Social Security, right? So if you worked as a teacher for a while, or, for the government, or some, non-covered employment where you're not actually paying into Social Security, those would not count in this earnings calculation, right? And what they do is they take your 35 highest wage earning years and they run it through a formula, and that comes up with your PIA, which stands for your primary insurance amount. That's the amount that you would get at full retirement age. If you ever get a statement from Social Security, that's going to be the big bold number at the top of the statement that they're showing, hey, you're going to get, whatever, $2,500 a month at age 67, or at your full retirement age, or 66 and a half, or whatever your full retirement age is. You can technically take Social Security as early as age 62, but if you do that, you're going to have a permanent reduction to your benefits, right? It is permanent, contrary to popular belief. The government, unfortunately, is not so nice that they'll just increase your benefit magically once you hit full retirement age. I wish that was the case. So again, this is a big decision, because if you take it at 62, you're getting money earlier, but you're also permanently reducing that benefit. Or you could technically wait till age 70. So if your full retirement age is 66, for example, you could delay all the way up till age 70. And every year you delay, you're going to get what they call an 8% delayed retirement credit. It's an 8% increase to your benefit every year up till age 70. And 8% is no joke. I mean, Larry and Sharice, not to pick on you guys at all, but do you have any CDs at the bank right now that are paying 8%?
Not even close, Joe. This is Larry. Yeah, it's funny because there's some folks that want to earn that, but interest rates are about as low as they've ever been. So that's incredible.
Yeah, and again, that's not no bank has a CD rate even close to that. I was kind of asking a rhetorical question, but to Larry's point, it's insane. Everybody would love an 8%. So again, I'm not saying that everybody should delay their benefit, but I think an 8% growth guarantee on an income stream that's going to last you the rest of your life, that's powerful, right? That's something to think about, when making that decision. So one last point before I move on, the average index monthly earnings, it does take into consideration your 35 highest wage earning years. That is a really big reason why you should always double check on that ssa.gov website, because believe it or not, every once in a while, I know this might be hard to believe, but the government does make a mistake from time to time. It's crazy, I know. Kidding, obviously, but in all seriousness, it is important to check. I've done maybe 100 of these Social Security presentations, and without fail, typically someone says, you know what, I actually saw that. One year I made 80,000 and the government reported I only made, 60,000 or something like that. And you have to prove it, right? You're gonna have to send them like your 1099 or your W-2 or whatever, you paid taxes on, but they will adjust it. And, that's a big deal, because if you have one number that's drastically underreported, that could have an impact on what your actual benefit would be. So you don't want to mess that up. But again, even though you'll need 10 years of working history, you really want to get close to 35. Because if you only have 10 years of working history, you can kind of guess what number they use for the other 25 when they do that calculation. It's going to be a 0. And I'm not a mathematician, but if I'm averaging 35 numbers and 25 of them are zeros, right? If I only worked for 10 years, I only have 10 years of work history, that average is going to just get decimated. I mean, it's going to bring that down drastically. So again, only need 10 years to qualify, but reality of it is if you don't have at least 25 to 30 years minimum of work history, your benefit unfortunately is probably not going to be all that big. So anywho, and again, if you have questions, feel free to chime in. So we kind of talked about how you can take benefits early. We talked about how you could delay taking benefits. The magic question kind of is really when to start benefits, right? Again, if you take it at full retirement age, you get the full amount. On the chart here, you can see what the full retirement ages are based on your year of birth. So if you're born between 43 and 54, your full retirement age is 66. And it's a sliding scale down to 67, or up to, I guess, if you were born in 1960 or later. And you can see what the age 62 reduction would be. So if your full retirement age is 67, but you want to take Social Security early at 62, whatever your full retirement age benefit is, you'd have to reduce that by 30%. That's a big deal, right? If your full retirement age benefit's $1,000 a month, you just drop that down to 700, or if it's 2,000 a month, you just drop that down to 1,400. Now, sure, you're getting your money sooner, but you're getting a lower benefit for the rest of your life. So the ultimate question, to an extent, right, there's a million other factors we want to take into consideration here, and we're going to talk about some of those other ones, but probably the best starting point, in my opinion, for trying to figure out when to take Social Security, a lot of it has to do with your longevity, right? And be real with yourself. I mean, if everyone in your family is living to be 100 years old, well, guess what? You should probably plan a retirement that gets you to 100 years old, if not more. If everyone in your family is not doing well, but you're super healthy and running marathons and eating well, maybe you kind of discount your family's history, right? If they haven't taken as good a care of themselves as you have. So be very realistic about this, because longevity is going to be probably the most important factor in determining when you should take Social Security, but there's other factors too, obviously, can you pay your bills? Are you still working? Survivor's benefits, we'll talk about that stuff too. But on this chart here, you can see they're showing starting ages across the left-hand side here, excuse me, and ages on which how much money you would have accumulated at that time. So for example, if I only live till age 70, my best choice, just in terms of pure dollars and cents in my pocket, would be to take it early, right? The longer you live, the more it's going to encourage delaying taking your Social Security, because you're getting that higher benefit for a longer period of time, right? If I take benefits at 62 and I only live till age 70, I would have accumulated 144,000. However, if I start waiting until full retirement age and I only live till age 70, I would have only accumulated 96,000. But if I live to the ripe old age 90 and I started at 62, I don't know why this keeps doing this. I would have accumulated over $500,000. And if I waited until full retirement age and lived till age 90, excuse me, I would have accumulated, call it 576,000. So again, the longer you live, the more it potentially makes sense to go ahead and delay that benefit and get those delayed retirement credits, get that 8% increase. So any questions on that one before we move on? Cool. And this, by the way, for those of you on the call, this is a very elementary version, very elementary, of kind of the Social Security tool that Larry has available to him. His is infinitely more sophisticated than this because it's going to take into consideration cost of living adjustments, spousal benefits, survivors benefits, all these different things. And it can even show you like a break-even analysis. But in a nutshell, this is very similar on the surface, at least, to what some of these planning softwares can do, which is kind of cool. Okay, so one big thing that a lot of people don't think about is working in retirement. And what I mean by that is taking a Social Security benefit early, but then continuing to work and earn income. So hopefully this never happens to you on purpose. Most of the time when I see this, people got laid off from a job, at 62 or whatever, and they needed some income. So they started drawing Social Security. And then, a few years later, a year or so later, they regained employment. So hopefully you don't do this on purpose. But every once in a while when I do a seminar, I'll have somebody say, oh, this is great, Joe, but, I don't trust the government or whatever. I'm just going to take my benefit as soon as I can. And I say, okay, I get that, I guess. But are you going to continue to still work? And if the answer is yes, this is why please, please, please don't do this. If you start drawing Social Security between age 62 and the year in which you hit your full retirement age, so this is January 1st of the year in which you hit your full retirement age, you're going to have your benefit reduced $1 for every $2 above 18,960. And we'll show you an example in a second here. But then from January 1st of the year in which you hit your full retirement age, all the way up until the first day of the month in which you hit your full retirement age, you do get a little bit more leeway. Your benefit's only going to be reduced $2 for every $3 you earn above 50,520. So you can make a lot more money once you hit January 1st of that year in which you're going to hit full retirement age. And then once you actually hit full retirement age, there is no longer a reduction, right? You can work as much as you want. You can make as much money as you want. You're going to pay taxes on it, which we'll get to in the next slide. But your benefit's not going to be reduced or withheld by continued employment while receiving a Social Security benefit. And again, this only happens before you hit full retirement age. So if you're going to wait till full retirement age to take Social Security, this is a complete non-issue. But just to put it in perspective, check this example out. Here's Susan, who was born in 1959, and she was eligible for maximum benefits. Her benefit was going to be $18,000 a year, but since she took it early at 62, right? They're saying she retired on her 62nd birthday. Her benefit already is reduced by almost 30%, so it dropped already from $18,000 down to $12,000. That year, she made $40,000, which, hey, that's decent money, but it's not like she's some huge six-figure earner or something crazy, right? The earnings limit is $18,960. She had excess earnings of $21,040. And remember, it's reduced $1 for every $2 above that limit. So basically cut it in half. And she's going to have a reduction of $10,520. So basically they're taking that $12,000 number and they're going to reduce it by $10,000. And she's left with a $2,340 benefit for the year. All right, if you divide that out, that's less than $200 a month that she would actually be getting from Social Security because she made $40,000. So again, if you're going to continue to work, really think about this if you plan on taking Social Security early. And again, this is all sweat off the brow income. This is not passive income. This is actually earned income, sweat off the brow, earned income. So keep that in mind as well. Any questions on this one, guys? It's a quiet group today. All right, so these next few slides are my least favorite, and I think everyone's least favorite, but nobody likes taxes, obviously. But it is
Hey,
good to know.
Joe?
Yeah, yes,
Joseph?
ma'am.
It's Lynette. I had a question and I forgot to unmute my little icon on the
Oh, you're
on
okay.
the screen. Back to Susan's example, that net Social Security benefit, is that only for that 1 year though?
Correct.
The 1 year
yeah.
that she made the 40,000, it's not going to be, she's not going to be penalized and get that from now on, right? It's just
Absolutely. Yep. It's just going to be in the,
Okay.
you're only going to have that. Great question. You're only going to have that
Okay.
reduction in years where you actually earn income. But again,
Okay.
you know, if this happens to you, in my example of getting laid off, you know, kind of is what it is, but never do this on purpose. I mean, $200 a month, that's not changing anyone's stars. You know, it's not
Right.
worth it at all. So,
Right. Right. Okay. I just wanted clarification on that. Thank you.
no, fantastic question, Lynette. Thank you. So taxes, this is whether you're full retirement age or not, it does not matter. Death and taxes, right? Those are the two things that we can never avoid in this life. We all know how Social Security is funded. If you've ever looked at your pay stub, it is probably not super exciting to find out that you are most likely going to have to pay taxes on a portion, probably a large portion of your Social Security benefit when you actually receive it. Sounds like double taxation. Well, kind of is maybe, but it is what it is. It's better to know now than to find out later, so you can more adequately plan for retirement and try to get a good gauge on how much you're actually going to get to spend of that Social Security check after taxes. So simply put, to find out if, or more likely what portion of your Social Security benefit would be subject to taxation, they do a calculation called your combined income. And your CPA or whoever helps you with your taxes should be doing this for you. But all they do is they take your adjusted gross income, which, by the way, this does include distributions from a 401k. And at age 72, whether we like it or not, the government requires us to take out what we call required minimum distributions from 401ks and IRAs. So there will become a point where you can't necessarily control this number maybe as much as you would like to. So keep that in mind. And then number two, they add up non-taxable interest, which if any of you own municipal bonds could be a great way to get some quote unquote tax-free income. However, keep in mind, it could have an implication on how much of your Social Security benefit that you pay taxes on. So that is a big important thing to know. And then lastly, they do add up 1/2 of your Social Security benefit, which again, if your Social Security benefit is $3,000 a month, that's 1,500 times 12. You're already at 18,000 just with your Social Security benefit. So it's not hard to break into these, you know, higher brackets here, especially if you're in a married couple situation. But simply put, here's how it works. And I'm going to try to erase this. Oh, cool. Sorry, this annotate function is a little tricky on here. So once they figure out this calculation for your combined income, let's use a married couple filing jointly. If your combined income is under 32,000, good news, you do not have to pay taxes on any of your Social Security benefit. However, if your Social Security benefit falls between 32,000 and 44,000, up to 50% of your Social Security benefit could be subject to taxation. Now, don't panic. I'll use my example. If your Social Security benefit is $3,000 a month and you fall in this gap right here between 32,000 and 44,000 for your combined income, up to 1,500 of your Social Security benefit could be subject to taxation, but it's not like they're going to tax it at a 50% tax rate or something crazy. That 1,500 will be taxed at your ordinary income tax level. So if that's 22% or 25% or whatever, that's what it would be taxed at. So it's not like they're taxing at 50% or something crazy. But it is good to know, right? Because if we're paying taxes on half of our Social Security benefit, we're not getting to keep all of it, obviously. So you definitely want to plan for that. And lastly, if your Social Security, or excuse me, if your combined income is 44,000 or more, up to 85% of your Social Security benefit could be subject to taxation. And again, that would be at your ordinary income tax rate. So it sucks, excuse my language, but I'd rather know now than, when I get to retirement and realize, holy cow, I thought I had this thing, down pat where I was going to be able to pay my bills with Social Security and, maybe pulling a little bit out of my 401k, but man, Social Security is definitely not giving me maybe as much income as I had hoped or thought it would. So I'd rather know now than before it's too late. Any questions on this stuff? This is a big one too. No? Cool. All right, so kind of the grand finale when it comes to Social Security, and then like I said, we'll touch very briefly on Medicare, and then I'll bring Larry and Sharice back up for just a couple closing comments here. But we've earned our 40 credits, we've assessed the family situation and kind of figured out roughly what age we think it makes sense to file. Now we're going to actually file. And we'll really talk about two pretty simplistic scenarios. Number one, if you have a spouse who does not qualify on their own earnings history, right? Maybe, spouse A was the breadwinner and spouse B, worked within the home, took care of the kiddos or whatever, just didn't pay in to Social Security. The good news is that spouse B, the non-qualifying spouse, can actually qualify off spouse A's record, right? You had to have been married 1 year, or if you're the parent of their child, that would be good enough for qualification purposes. And the non-qualifying spouse, they could receive up to 50% of the qualifying spouse's primary insurance amount. I said that very carefully on purpose because a lot of people say, oh, well, I can get half of my husband's or half of my wife's benefit. That's technically not true. Because if your husband or wife delayed their benefit, you're not going to get half of it as it grew with those delayed retirement credits. You're still only going to be eligible to get half of the primary insurance amount, aka the amount that they receive at full retirement age. So if your full retirement age benefit is $3,000, regardless of whether that other spouse delays their benefit or not, the non-qualifying spouse would only be able to get up to half of that $3,000. So hopefully that makes sense. The other thing that's really important is the key word I said is up to, right? They could receive up to 50% of that full retirement age benefit. They only get the full 50% if you yourself wait until your full retirement age benefit, right? If you as the non-qualifying spouse actually wait until your full retirement age to get that benefit. If you take it early as a non-qualifying spouse at 62, you would have a permanently reduced benefit. So the benefit would be based off of half of the primary insurance amount, but it would be further reduced for taking it early. And actually, unfortunately, oops, screwed that up. Unfortunately, the spousal benefit reductions are more severe than they are for an earned benefit. Remember, the earned benefit reductions range from 25% to 30% was the age 62 reduction. The spousal benefits, the age 62 reduction ranges from 30% all the way to 35%. So if you wanted to take a spousal benefit at 62, it's going to be based off half of your spouse's PIA amount, but then further reduced by another 30 to 50%, or excuse me, 30 to 35%. So it's not going to be that big of a benefit in that scenario. But at least you can still qualify for one, even though you technically didn't pay in enough years to qualify. Any questions? Feel free to chime them in, guys. Situation two is if both spouses qualify for their own records. And this is pretty easy. Spouse A, the higher wage earner, the primary wage earner, they're going to have the higher earnings record. They're going to have the higher benefit. It's just how it is. That's just how they calculate the benefit. It's based on how much money you made and your highest 35 wage earning years. So there's never really going to be a scenario for that individual to draw off the other person's record. There used to be, but Social Security has changed quite a bit over the years, and that strategy is no longer available. However, that person's going to draw earnings off their own earnings history, and then the spouse, the lower wage earner, would have a choice basically. They could either take their full benefit, right, or they could take up to half of the spouse's. So this is a pretty easy math situation. If your spouse's benefit is $2,000 a month at full retirement age and yours is only $800 a month, well, guess what? You're going to take half of the spouse's. Pretty simple. Half of 2,000 is $1,000. However, if your spouse's is $2,000 a month and your benefit, is like $1,800 a month, for example, well, obviously you're going to collect off your own record, right? It's a pretty simple math equation to kind of figure out what's going to make sense. But you can't do both, right? That used to be the thing where you could take a spousal benefit and delay your own benefit. The Bipartisan Budget Act of 2015 did eliminate those strategies. That was called the file restricted strategy, or file for spousal only benefits. That is no longer in play due to the Bipartisan Budget Act of 2015. So keep that in mind. It used to be that you could do some really creative things. Unfortunately, that is really no longer the case. And that's kind of what this slide is talking about. But again, that one has essentially been phased out. So, all right, last couple ones here, guys. Benefits for survivors. This is the one strategy that you can actually switch, or not really strategy, but type of benefit, I should say, that you can actually switch once. Survivors benefits are eligible as early as age 60. However, keep in mind that all the same rules apply. So if you are eligible for survivor's benefit at 60, but you're still working, it might not be the best idea to start drawing that survivor's benefit. Because again, we learned from the example of Susan, I believe it was, where, look, you don't have to make a ton of money to completely wipe out that benefit, right? Susan was making 40 grand and she completely wiped that out. Those rules still apply for survivor's benefits as well. And obviously age 60 is well below your full retirement age. Now, if you qualify for survivor's benefit and you qualify for retirement benefits, you can actually switch once. So this is where you can get a little more creative. Obviously it's terrible if your spouse passed, but from paying the bill standpoint, there is some additional flexibility here where you could actually start a survivor's benefit, allow your own benefit to build up, till age 70, for example. And then all of a sudden at age 70, then you could switch to your earned retirement benefit. So you can get a little bit more creative with survivor's benefits than you can a actual spousal benefit these days. Okay. And last but not least here, we have divorced spouses, right? Believe it or not, if you were married for at least 10 years, you and your ex-spouse are at least age 62 and you remain unmarried, you could actually collect off the record of an ex-spouse. In fact, if you collect off the record of an ex-spouse, it has no impact on what they can receive, or even if your ex-spouse has since remarried, it has no impact on what your ex-spouse's current spouse could receive. Odds are they have no idea that you're doing it, unless you tell them, I guess. But again, it has no impact. And but this is not like a special situation that you can manipulate, contrary to popular belief. An ex-spouse benefit is, in all intents and purposes, a spousal benefit. So again, you could take either your own benefit or up to half of your ex-spouse's benefits. So it's not like it's some magical thing. You're going to want to take the greater of the two. And if you have any earnings history at all, 25 to 35 years, most likely your benefit is going to be higher than half of your ex-spouse's benefit anyways. So it might not even be that big of a deal, but it is good to know, obviously, if anyone has that situation out there. Okay, any questions about Social Security real quick before we touch on Medicare very, very briefly? No? Cool. So last couple slides here, we talked a lot about Social Security. Social Security and Medicare really kind of work together to an extent. But regardless of your full retirement age, you can actually start receiving Social Security benefits as early as age 65, right? And your Social Security eligibility, it basically works the same way as, I said that wrong. Your Medicare eligibility works the same way as Social Security. You had to have paid in, for the 10 years. But if you haven't, if you have a spouse that did, then you would qualify based on that spouse. And if you're already receiving Social Security benefits, you're actually all automatically enrolled in Medicare. But if you're not taking Social Security benefits when you get to age 65, you need to apply 3 months prior. That's the open enrollment period, and you want to make sure you get in there so you don't have any lapse in coverage. Now, if you're still working, you still have to enroll in Medicare, but you don't have to actually like pay for the Part B. You just have to sign up for Part A, which I'll explain that here. There's 4 parts to Medicare. Part A is just your hospital insurance. There's no premiums, so you're not actually like paying anything on a monthly basis, but there are copays and deductibles. So if you actually have to use the insurance, you'll have to pay, but there's no monthly premium. And again, if you're still working your job at age 65, that's the part that they're going to have you enroll in. It's always best to work with your HR department though, because they'll know what they want you to sign up for and not want you to sign up for, and they should make that pretty streamlined for you. Part B though, once you are no longer on an employer's insurance, that's what you're going to want to get. That's your medical insurance. There's a premium amount for that. And the premium amount is means tested, meaning the more you make, the more you're going to have to pay. But right now, average Part B premium is called about $155, I believe, $155 for folks that are in the lowest bracket there. And if you make a ton of money, you could get bumped all the way up to, I think, like $400 a month or something, but you have to make some pretty serious cash to get bumped up in the Part B premium. And then there's also Medicare Advantage plans. There's pros and cons to these, which we'll talk about, but there's a whole variety of them designed for different people and different coverages. And then last but certainly not least, we have our Part D plan, which is our prescription drug coverage. Part D is very easy to figure out. There's actually websites that literally you type in what prescriptions you take and how often you take them, and it'll literally spit out the best plan, or the most cost-effective plan, I should say, for you. So Part D is very simple actually to figure out. There's websites that pretty much do it for you, but average Part D premium is about 30, call it $40 a month. So reality of it is you have Part B premium coming out of your Social Security check. That's about $155 a month. Part D, call that another, $40 a month. So you have about $200 a month coming out of your Social Security check before it even hits your account. And that's all before you even start to think about the whole tax implications and considerations. So the point of this is not to be that, a Debbie Downer or give you bad news, but to really get the wheels turning and thinking about, okay, I'm not going to get to keep that full $2,000 a month or $2,500 a month or $1,200 a month. I need to plan for that, right? Because a chunk of it's going to come out for Medicare, and then a chunk of it's going to pay taxes. And again, these are just the premium amounts. You're paying $200 whether you step foot in the doctor's office or not. Anytime you step foot in the doctor's office, you're also going to have copays and deductibles that you have to hit before the actual insurance starts to kick in. So you actually should plan on a lot more than $200 a month if you're going to average that out over the year and plan to actually go to the doctors. So last little thing here.
I have a quick question on that.
Absolutely.
Those premiums are just at the individual level, not family coverage, right?
Correct. Yeah. So if you had a husband and wife situation, you multiply that number by 2.
Got it. Thank you.
Yep. Great question. So when you finally get to Medicare age, essentially you have to make a decision. And again, there is no one size fits all, but in general, you'll be faced with the choice of original Medicare and a Medicare Advantage plan. There's pros and cons to each one. Original Medicare, people tend to like because it's basically accepted everywhere. There's no like network really you have to stay in or anything like that. That's going to include parts A and B, which again, you're paying a premium for Part B, whether you use it or not. You're definitely going to do Part D. And then a lot of people do a Medigap plan. The Medigap plans are kind of cool. They can cover the copays and deductibles, but you're also paying a higher monthly fee. So a lot of people like the Medigap plans because it's just easier to plan for. Instead of paying $200 a month and then every few months, all of a sudden you have to write a check for, $700 or something crazy to meet the deductible. With the Medigap plan, you might pay more like, and these are just rough examples, by the way, but you might pay like $300 a month or something. But that also covers the copays and deductibles. So you pay a little bit higher monthly, but it also helps you manage those expenses throughout the year. You're not going to get hit with a really big bill one month or something crazy like that typically. So some people like that, some people don't. It's not a one size fits all, obviously. But the advantages to Medicare Advantage plan is you can really control the cost, right? They have Medicare Advantage plans that are like premium free. But again, your copays and deductibles are going to be insanely high. So if you're super healthy and you don't think you're going to be using the doctors right away, sometimes it makes sense to start with a Medicare Advantage plan because, again, you can get that premium down super low and just have more of like a catastrophic coverage. The biggest negative side to a Medicare Advantage plan is it kind of works like an HMO or a PPO. You have to get coverage in that network, which could be fine if you're not going to be traveling much in retirement, or maybe you live in the same city the whole year. Maybe that's not as big of a deal to you, but for some people, they don't necessarily love that. They'd rather choose their doctors and things of that nature. So again, that was a very rough, just kind of scratching the surface, elementary version of Medicare, but hopefully at least a couple of those things kind of stuck with you. So with that, I will bring it back to Larry and Sharice if you wanted to have any closing comments. Otherwise, if there's any questions, feel free to chime in as well.
Hey, Joe, this is Larry. We really appreciate your help. You're always very knowledgeable about Social Security and kind of what it is. It's definitely a little confusing when you're doing all this. So that's why we try to do this a few times a year. And one thing we'll offer is if anybody has any more detailed questions, we can always sit down face to face or even on the phone and kind of go over each person's individual benefit. Because Joe mentioned this, we do have tools where we can go through and we can pull up your stuff and we can kind of break it down and figure out, like, some people want to take it at 62 or wait till 70 or somewhere in between. So that's one thing we can do. So if anybody has questions, I put my phone number in the chat, but it's 303-870-3853. That's 303-870-3853. Or you can get a hold of me through the credit union too. So I'm always available. Just call the contact center and tell me you want to talk to me and they can get you my number. So again, I really appreciate it, Joe. Very knowledgeable and we appreciate it. Thank you for everybody for attending, and that's about it. I might be reaching out to you just to see if there's any more questions, so, or you can reach out to me too. So thank you again so much. Does anybody else have any questions, or does anybody want to ask Joe a question or anything right now? Well, again, I don't want to, I know this is everybody's lunchtime, so let's let everybody get back to what they're doing, and we appreciate it. We are going to do this tomorrow, so if anybody wants to join, we're doing the same time tomorrow. So thank you so much again. Appreciate it. And Joe, I guess that's about it, right?
Absolutely, yeah. Unless Reese had any closing comments or anything, but I appreciate you guys allowing me on, and thank you for everybody that joined today.
All right.
Thank you so much, Joe.
Thank you. Yep, we'll see y'all tomorrow.
Okay.